One reason that dollar cost averaging has been such a historically great fit for most regular investors is that it allows you to create some sort of separation between the emotional aspects of investing in volatile assets and the choice you make to invest in those volatile assets. There are a lot of strategies that involve regularly tracking the performance of your investments, or just assets in general for that matter, and using that data to make decisions about when to buy and when to sell. Think about value investing, for instance. The whole idea behind value investing is to find investment opportunities that are currently on sale for less than they're actually worth, so that you can buy low and sell high. This is a strategy that was used to great success by Warren Buffett, among many others. Or think about momentum investing, which is kind of on the other end of the spectrum from value investing. Instead of buying low and selling high, the idea behind momentum investing is to find investments that have recently experienced a strong and consistent price trend, for better or for worse, and then bet on that trend continuing. In other words, the idea is to buy high and sell higher, or vice versa, buy low and sell lower. Historically, this has also been a fairly successful investing strategy for many investors. And then there's the more focused investing strategies, such as buying individual stocks or even individual sectors within the broader stock market. We know that those can be successful strategies. I mean, look at the people who invested in meme stocks recently and then sold before they came crashing down. They made an absolute killing. And then what about the people who use highly leveraged investing strategies, either by trading on margin or investing into some sort of leveraged ETF or mutual fund in the hopes of maximizing their gains? Especially during good economic times, this approach can be enormously profitable, even when compared to a standard dollar cost averaging approach in the same assets. So when I say that dollar cost averaging is arguably the best investing strategy ever created for regular people, it's not because these alternative strategies can't be successful, because they absolutely can, tremendously so in fact. However, in most cases, there's one or more caveats to keep in mind when we're talking about most investors. For instance, people trading on margin or using leveraged funds can make a killing during great economic bull runs. But during bear markets, or markets that trend in a way that they weren't expecting, if these investors aren't careful, they can easily go belly up. Similar things could be said for people who use less diversified approaches. If you invested in a single stock and that stock went up, that's great. However, if it doesn't, you don't have anything else in your portfolio to balance out that loss, which can be pretty detrimental, especially if you put a lot of money into that investment in the first place. Value investing can be tremendously lucrative, even over the long term, as long as you're willing to put in the time to research all these individual companies and are able to stick to your guns when things don't materialize as quickly as you'd hope. Because the reality is that, generally speaking, when you're a value investor, you're going to find yourself taking on companies that have recently fallen on hard times. This could be because their business has been slowing down recently, or because they've gotten themselves into hot water with the press, or because factors beyond their control make it seem like their company, or even their whole industry, is going to take a hit in the near future. Look at airlines during 2020. Those are some of the most common reasons why an investment ends up trading at bargain prices. And as a value investor, you've got to be able to look at that and be comfortable pulling the trigger and buying when things are looking like they're at their worst, because that's where most of your gains come from. You've also got to be willing to cut an investment loose once its value dries up. This is often pretty difficult to do because, for its value to dry up, it generally means that the investment would have been on fire recently and growing like crazy. But it's something you have to be able to do with this strategy regularly in order to maximize your long-term returns. Finally, you've got to be willing to keep going even after you've hit a rough patch where several of your investments have not panned out. Because, well, you're taking on risky positions. A lot of them are not going to work out. That's just the nature of the beast with this approach. These potential hurdles are things that can definitely be overcome, and many investors have managed to overcome them, at least enough to earn market-beating returns. For instance, Warren Buffett has averaged returns of around 20% per year throughout his investing career, which is roughly double that of the market as a whole. However, it's not easy. If it were, everyone would be doing it. But we know from the numerous studies that have been done on the subject that the majority of active traders fail to even match the market's returns when all is said and done. And the increased difficulty of separating emotions from decision-making is, I believe, one of the reasons for that reality. The second reason that dollar cost averaging has been such a historically great fit for regular investors is that it has history on its side. The stock market, drama queen that it is, tends to go through regular cycles of irrational exuberance and celebration, and rampant, unrelenting pessimism and fear. Unlike a lot of other trading strategies, particularly those that seek to maximize returns through tighter focus on individual investments or leverage, dollar cost averaging works just as well in bear markets as it does in bull markets. Take, for example, the lost decade of the 2000s. From January of 2000 through the end of December 2009, Vanguard's original S&P 500 index fund averaged returns of about negative 1% per year, due largely to the popping of the dot-com bubble in the first half of the decade and the Great Recession in the second half. However, if you had started investing $500 a month in January of 2000 and continued investing $500 a month for the rest of that decade, your net worth would have still grown substantially despite the near lack of returns from the investments themselves. By the end of the decade, you would have had a nest egg valued at around $73,000, and the majority of downturns during this period would have been recovered from fairly quickly. The dot-com crash wouldn't have manifested in a sustained drop in the value of the nest egg until around the summer of 2002, and it would have set new highs by that October. So from the value of the nest egg's perspective, that lasted about the length of a summer, while the market took about 6 years and 3 months to recover. The Great Recession was obviously tougher because at that point we'd been investing for several years, so the ratio of our ongoing contributions to the size of our overall nest egg was smaller. But it still made quite the difference in the time that it took to recover from a portfolio value standpoint. The markets themselves took about 4 years and 10 months to recover. Our hypothetical nest egg set new highs by February 2010, or just 2 years and 4 months after its peak in 2007. So dollar cost averaging, at least in this hypothetical, shaved off about 2.5 years of the underwater period. Now you might say, well Dan, the strategy doesn't actually do anything to increase your returns during the bear market. So it's not that the strategy is doing good, it's just that you kept investing. So of course your net worth would have grown and the value of your nest egg would have recovered quickly. And you're right. But that's kind of the point. Dollar cost averaging helps to keep your net worth growing, especially in the early parts of your investing journey, which are often the most uncertain and anxiety-inducing times because you don't have much of a financial cushion to fall back on, while helping you to keep your emotions separated from your investing decisions. Because of that, even if we're bemoaning the fact that our nest egg is not growing as fast as it was before, and certainly not as fast as we'd like to, we're still less likely to sell everything and totally give up on the strategy, relatively speaking, because the numbers we see when we log into our 401k account is usually growing. We're still making progress, or at least limiting the downside. And that's a huge perk, because remember, simply due to how the math behind compounding interest works, the most valuable time to be invested is generally the last few years of an investing career, because that's when the interest earned on your investments is going to be the largest, as you can see from this chart illustrating the interest earned on a $10,000 investment during each year of a hypothetical investor's time horizon, assuming average returns of about 10% per year. A third reason that dollar cost averaging has been such a historically great fit for most regular investors is that it's just so easy. If we're being honest with ourselves, we know that not everyone is going to have the time and knowledge or interest required to pull off every strategy. It takes a lot of time and some know-how to research a bunch of companies and make sure that their stock is actually trading at a bargain price, as opposed to legitimately being in serious trouble like a successful value investor would have to do. And it takes a lot of cojones, or naivete, to dump a huge pile of money into a single stock or a leveraged position. You could argue the same is true for people taking on a momentum-based approach. Not everyone has studied investing, and many have no desire to, but most people at least intuitively understand that buying a company when it's been on a run-up, while exciting, can be risky if it turns out that the company is flying too close to the sun and eventually reverts back to the mean. So again, cojones, naivete, or maybe some combination of both. Dollar cost averaging may seem on the surface like it has a lot of similarities in this regard because if you're dollar cost averaging, you're going to be buying when the markets have recently experienced a run-up. And you're also going to be buying when the markets have recently experienced a major correction. However, I don't think that it takes as much cojones to pull this off in this case because by design, dollar cost averaging is meant to be agnostic towards recent market performance. If you set things up and automate it so that you'll contribute funds from your paycheck every month, then you could genuinely go an entire investing career without having the faintest clue what the market is doing on any given day. Because by design, following the market's movements is not required for the plan to work as intended. And that accessibility, coupled with its history of long-term success, and the fact that it helps you separate your emotions from your day-to-day investing decisions, are some of the reasons that I believe dollar cost averaging stands as a real contender for the greatest investing strategy ever created for regular investors. But what do you think? Are there other strategies that are better suited for regular investors? Do you think there are any reasons that I failed to mention for why dollar cost averaging is so well suited for most people? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single month.